Hey everyone, today I'm going to walk you through how to build a solid investment portfolio with 75% allocated to treasury bonds and 25% in stocks. And just like this picture shows here, so the darker blue is the treasury bonds and then the 25% is the stocks, just to explain visually, all right? This is a balanced approach that aims to provide stability while also allowing for growth. So let's go ahead and dive right in. So the step one will be understanding treasury bonds. Okay, so I'm just going to explain that theoretically to make it easier, all right? But that's pretty much it. So first, let's talk about treasury bonds. What are treasury bonds? So they are government-backed securities, all right? So which means they're one of the safest investments that you can make. So by allocating 75% of your portfolio to treasury bonds, you're ensuring that a significant portion of your investment is secure and stable, all right? Treasury bonds offer a fixed interest rate over a set period, so you know exactly what to expect in terms of returns. But remember that you have to take into consideration inflation as well, like real inflation and stuff like that. And this is just the beginning, and this is just one example of a portfolio. Just remember that this is just one video, and we can play around with it as much as you can in the future. But for now, to make it short and simple, that's pretty much it, okay? And now step two, we're going to allocate to treasury bonds. So this portfolio, like I said, 75% goes to treasury bonds. So for example, if you have $10,000, 7,500 would be allocated to these bonds. Or for example, if you have $1 million or 100,000, 75%, same thing would go there. So this helps you protect your portfolio against market volatility, because even if the stock market takes a hit, your treasury bonds should remain relatively unaffected. So that's the goal with this type of portfolio, which is very conservative. All right, now the stocks, okay. The remaining 25% of your portfolio will be invested in stocks. So stocks, they offer the potential for higher returns, but they also come with a risk, which is volatility. So by keeping the stock allocation to 25% in this example, you're striking a balance between potential growth and managing risk, all right? And now choosing your stocks. So when selecting the stocks, it's really good for you to diversify across different sectors. So for example, you might want to invest in technology, healthcare, consumer goods, stuff like that. This way, if one sector isn't performing well, the others might balance it out. Okay, so for example, let's say you're investing $10,000 with 25% in stocks. That would be like $2,500. You could split this between a few strong companies in different industries to spread out the risk. All right. And over time, the bonds will change, which means your portfolio could drift from its original allocation. So it's important for you to check it periodically. So maybe once or twice a year or even more, rebalance if needed, because the stocks are going to be unbalanced because of the volatility and stuff like that. And also if you allocate every month, so you're also going to have to take that in consideration. But that's kind of how it works, okay? And another thing that, for example, if you want to make it very simple for beginner, you can have like maybe 75% on treasury bonds and then 25% on S&P 500 index. That's not a investment like I don't know. That's not an investment advice, although I'm saying that because this is just for educational purposes. But that's what I do with my life, and that's what a conservative portfolio would look like. For example, 75% on treasury bonds and then 25% on S&P 500, because we know that we're talking about the strongest economy in the world, which is the US companies, and everything is there. So it makes it very easy and intuitive for the beginner who never really bought a share of stock or never really understood what it is. So it's very simple and safe for someone who barely started or just got started into high risk investment and stuff like that, and don't want to lose money. So that would be a ideal portfolio if you want to expose yourself into volatility while at the same time maintain your conservativeness or being conservative, having 75% on conservative portfolio, okay, on treasury bonds. So that's just the beginning of it, all right? There are many ways that you can do it, and there are a million ways that you can create a portfolio, but this is just, like I said, the beginning of how you would do it. But that's pretty much it, and that's what you need to understand if you want to invest your money. And I strongly talk about investing your money because not only do you need to make money, but also if you want to become someone who's going to become financially independent in the future, you need to also invest your money and invest it good, because if you invest it bad, you can lose it and you could blow up your account, or I don't know, going bankrupt. And I don't want none of these things happening to you. Sorry about it. So yeah, that's pretty much it. Thank you so much for watching the video. This is just a very quick intro about portfolio allocation and stuff like that. So thank you so much for watching this channel. Subscribe for more. We're going to be talking about entrepreneurship in this channel and many other things. Other than that, thank you so much. I'll see you in the next one. Have a good one, guys. Bye.